Hello everyone. As most know, the industry of airline transportation is growing very rapidly. In fact, according to the FAA, U.S. carrier revenue per miles in 2034 are expected to be approximately 76% higher than the 2013 level. Additionally, the FAA states that air cargo traffic is expected to more than double in the year 2034 at an average growth rate of 4.1% per year. As business students at Cranach School of Management, our group hypothesized that the predicted explosive growth of the airline industry could potentially become a very viable source of revenue for investors, currently and future. From prior knowledge of the way that the airline industry works, we are very well aware that the fuel is by far the most critical cost that all airlines have to manage in order to stay profitable. In turn, we decided that it would be quite useful to determine how much a change in oil price and other forms of fuel affects the stock prices. For various airlines carried through analysis of intraday stock market data, determine a coefficient of how much a dollar increases in the price of oil, for instance, affects the stock price of certain airlines, could prove to be very useful. If coefficients are found through this analysis of data that are statistically significant, then it may become possible to create a computer application that automatically make trades on a minute-by-minute basis when there is a positive or negative situation, in terms of the stock prices of energy sources. It is important to note that the majority of airline companies hedge their oil funds. This means that airline companies are able to fix and cap their fuel price for a certain amount of time, while there is a cost of any airline who choose to hedge their fuel. Most airlines deem that it is quite necessary to do so in order to combat against the volatility of oil prices. Because of this volatility, our group determined that we could capitalize as investors by taking advantage. Since oil prices are constantly changing, mainly due to OPEC decisions, we could use them to determine how much this affects the stock price of certain airlines. As a hypothesis to begin with, our group believes that airlines who hedge will be less affected by a change in oil prices than the airlines who do not hedge their fuel. Now I will pass it to Prachant to talk about the method used in our research.
My name is Prachant Bradwell, and I will be talking about the method that we used in order to further our statistical analysis. Our main focus for this project was how oil affects stock prices, but we decided to further our statistical analysis to see if there was some sort of correlation with the intraday movement of stock prices of alternative energy sources. So for the purposes of this project, we chose to examine how airline stock prices may be affected by changes in a solar power ETF, TAN, a clean energy ETF, QCLN, natural gas, and gold, all on an intraday basis. Gold, while not being a source of energy, tends to follow the price of oil, so its price was included as another potential indicator that there may be some movement in the intraday price of airline stocks. So now I'll talk about our method of gathering the data. The data that we chose to analyze was intraday stock market data. The data is available on many different sources, such as the Bloomberg terminal, but we used Google Finance to obtain the data. We found an API from Google Finance that was quite simple to use through a macro in Microsoft Excel, which would pull intraday stock price data for the variables that we were dealing with for our statistical analysis. For the purposes of this project, we chose to pick a day that had very volatile oil prices, which was April 14th of 2015, as well as 4 other days. We determined that if the range of oil prices was 10 cents or greater, it would be considered a volatile day in terms of oil prices. Further, to support our statistical arbitrage, the price frequency that we used was every 3 minutes. We chose the short frequency because creating software to capitalize on potential changes in oil prices would allow us to make the trades on the dot on a minute-by-minute basis. So now, for our statistical analysis, we chose to use 10 different variables. We understood that certain airlines would be affected differently based on their approach in fuel hedging, as well as simply the size of the airline. Thus, we chose to use American Airlines, which is a large airline who does not currently hedge fuel, Delta Airlines, a large airline that hedges fuel, Southwest Airlines, a medium to large airline that does hedge fuel, and JetBlue, a small airline that hedges fuel. And those will all be dependent variables in our regression analysis. Our first step in doing our analysis was to do a correlation test just to see if oil actually did affect the stock prices for airlines. Because if there was no significant correlation with oil and airline prices, then there would pretty much be no point of doing the project. So I'm going to pass it to Chase to give you those results.
In order to test the significance of the relationship between oil price and individual airline stocks, we performed individual correlations between a commercial airline and the price of oil. Based on our analysis, American Airlines had the most significant relationship between oil with the correlation matrix of negative 0.95. The next airline stock that we analyzed was Delta, which had a correlation matrix of negative 0.88, which is less significant than American Airlines, making sense because the company hedges the prices of oil and is less impacted. We also analyzed Southwest Airlines, which had a correlation metrics relative to Delta Airlines at negative 0.87, again, less significant relative to American Airlines because this company also hedges the price of oil. Surprisingly, JetBlue had an insignificant relationship, which we believe is due to lower volatility being from a lower price airline company. In order to build a program capable of being consistent enough for trading, we included several other factors that may move in relationship with the price of oil, such that we can determine whether or not the movement of an individual stock is in fact driven by oil. For this, we used clean energy stock, clean energy ETF, the price of natural gas, gold, and the Standard & Poor Index as a benchmark in relationship to the price of oil and American Airlines stock. Based on our analysis, unsurprisingly, oil had the greatest correlation with American Airlines, but there were also additional correlations that we were interested in, such as the price of gold and the clean energy ETF. Given the significance of these overall movements, this implies that the movement of the stock price given AAL is not driven by largely events being held impacting AAL's earnings aside from the price of oil, but in fact due to the price of oil given its relationship to other variables that move in correlation with the stock. So, given this analysis, we are able to improve the speed of trades relative to technical traders that are looking to visualize the trends given on the intraday. The traditional method is to analyze the relationship in a given time period relative to the stock's price so that a trader can place a trade when a series of events occur in the market that are demonstrated by technical visuals on every 3-minute price movement. However, when waiting for these setups to emerge, trading algorithms are capable of placing the trades before traders can see the visuals emerge. Moreover, when we include multiple variables, we can demonstrate quantitatively that the price of the stock movement is in fact based on the price of oil. So given a statistical arbitrage model, when we are interested in determining the relationship of movements between two securities, we can in fact prove that the relationship is being moved based on the price of oil and not other factors in the market. So based on our model, we can prove that, demonstrate through the analytics that the movement is based on the price relationship to oil and not other factors, which may be difficult to tell by reviewing the technicals and not being able to include other factors when performing analysis. Second, technical traders need time to interact with the charts and analyze it mentally before placing a manual trade. The simple lag of human relay process takes time, and a machine being programmed to immediately activate the trade on a series of numerical variables as opposed to humans reviewing the graphs manually can take advantage of this statistical arbitrage, which will generate returns faster than an individual reviewing the stock charts. Therefore, based on our analysis, we believe that it may be advantageous to backtest a software capable of using our input variables and performing the analysis to activate a trade based on the price of oil for a specific airline stock, given that the other factors in our model are met. This concludes our presentation of how airline stocks are impacted by the price of oil and supports of how it could be profitable when implemented into a systematic trading relative to traditional technical analysis. Thank you. That was